Before we dive in, the important legal stuff first. I am not a financial advisor, and this video is for educational and entertainment purposes only. The information shared in this presentation is not, and should not be considered financial advice. Investing involves risk, including the potential loss of principal. You should always conduct your own research and consult with a licensed financial professional before making any investment decisions. Now let's get to it. On a quiet Sunday evening, August 15, 1971, President Richard Nixon sat down in the Oval Office and delivered a speech that would fundamentally change the nature of money for every single person on Earth. He looked into the camera and with a calm, reassuring tone, he announced that the United States would be temporarily suspending the convertibility of the dollar into gold. He called it closing the gold window. But what he really did was sever the final thread connecting the money in your pocket to something real, something tangible, something finite. For centuries, money had an anchor. The dollar was a claim check for a specific amount of gold held in a vault. But in that one moment, Nixon cut the cord. The dollar, and by extension the entire global financial system, was now floating free, backed by nothing more than the full faith and credit of the US government. Promise. At the time, an ounce of gold was officially priced at about $35. Today, an ounce of gold is hovering around $2,000. That's not a 30, 40, or even 100% increase. That is an increase of over 5,000%. Meanwhile, what's happened to the purchasing power of that dollar? The one from 1971? It's lost over 85% of its value. You need almost $7 today to buy what $1 bought back then. This isn't a conspiracy theory. This is just math. This is history. And it's the single most important, yet least understood, backdrop to every single financial decision you make today. Now take a look at your own investments. Your 401k, your IRA, your brokerage account. What do you see? For 99% of us, it's a sea of stocks and bonds. We buy the S&P 500. We buy a total stock market index. We buy bond funds. And we're told this is diversification. But is it? Think back to 2008. The stock market cratered. People's life savings were vaporized. What happened to bonds? Some held up, but many corporate and mortgage-backed bonds got crushed right alongside stocks. Think about the flash crash in 2020. Everything went down. Stocks, bonds, even real estate felt the panic. Think about 2022. The S&P 500 had a terrible year. But so did bonds, which had one of their worst years in modern history. In a real crisis, in a moment of true financial panic, all these paper assets, these digital promises, they suddenly start to act the same. They all go down together. It's a terrifying, helpless feeling. You look at your statement and there is nowhere to hide. Every line item is bleeding red. And that is the exact problem we are going to solve in this video. We are going to talk about the one major asset class that is almost certainly missing from your portfolio. The one asset that has a 5,000-year track record of preserving wealth through every imaginable crisis, every war, every currency collapse, every single empire that has risen and fallen. We're talking about gold. But here's the critical difference. We are not talking about buying expensive coins from a late-night TV ad. We are not talking about burying bars in your backyard or renting a safe deposit box. This isn't a doomsday prepper video. Frankly, for most people, that's an inefficient, expensive, and insecure way to own gold. We are talking about exploring gold as a modern, liquid, and accessible asset class through a tool you already know and use, the mutual fund. We're going to demystify how you can add the stability and historical power of gold to your existing retirement or brokerage account with just a few clicks. This is about making a smart, strategic allocation to an asset that zigs when everything else zags. It's about building a truly resilient, all-weather portfolio that doesn't just grow in the good times, but protects you in the bad times. You've probably seen the fear-mongering ads online. The dollar is about to collapse. Buy gold now before it's too late. That's not what this is. We're not here to sell you fear. We're here to give you clarity. We're going to look at the data, the history, and the practical mechanics of how gold actually works inside a diversified portfolio. We're going to cut through the hype and give you the unvarnished truth. Over the next few minutes, we're going to break down the 3 core reasons why a small allocation to gold can be one of the smartest financial moves you can make. It has nothing to do with getting rich quick, and everything to do with staying wealthy long-term. First, we'll explore its role as a hedge against inflation and currency devaluation. We already saw what happened to the dollar since 1971. That trend isn't reversing. Every new dollar that gets printed makes the ones in your savings account worth a little bit less. Gold is the antidote to that. Second, we'll see how it acts as chaos insurance. When geopolitical tensions flare up, when markets panic, when there's a true flight to safety, where does capital go? It goes to U.S. Treasury bonds and it goes to gold. It's the ultimate safe haven asset when trust in the system gets shaky. And third, and this is the most important part for a portfolio, we'll examine its power as a true diversifier. Because gold often moves in the opposite direction of stocks, it can act as a powerful stabilizer for your portfolio, smoothing out the wild rides and reducing your overall risk without necessarily sacrificing long-term returns. But I know what some of you are thinking. Wait a minute, gold doesn't do anything. It just sits in a vault. It doesn't pay a dividend like a stock. It doesn't pay interest like a bond. Warren Buffett hates it. And you are 100% correct. Gold doesn't produce cash flow, but that's because you're judging it by the wrong criteria. That's like complaining that your fire extinguisher doesn't also cook you dinner. That's not its job. The job of the stocks in your portfolio is to be your offense to grow your capital. The job of gold is to be your defense. It's the goalie. It's the insurance policy. You don't buy homeowners insurance hoping your house burns down, so you can cash in. You buy it for peace of mind so that if the unthinkable happens, you're not wiped out. Gold plays a similar role in a portfolio. For years it might seem boring. It might just sit there. But then, when the fire starts, when the market is in freefall, you will be incredibly grateful you have it. It's the asset you own hoping you never truly need it to do its job. The world is a far more uncertain place than it was 20 or even 10 years ago. We have record levels of government debt, persistent inflation, and rising geopolitical tensions. In this environment, owning only stocks and bonds, only paper promises, is like setting sail across the ocean in a boat with no life rafts. Maybe you'll be fine, but why would you take that risk? So the real question isn't if you should have some exposure to the oldest and most durable form of money in human history. The real question is how. How do you do it intelligently? How do you avoid the scams and high markups? And how do you integrate it seamlessly into your existing investment strategy? That's where the world of gold mutual funds and ETFs comes in. And that is where things get really interesting, because it's never been easier for the average American investor to add this powerful asset to their arsenal. We're about to break it all down. So let's start with the absolute basics. What exactly are these things? Forget the jargon for a second. Think of a mutual fund as a giant financial potluck. You and a bunch of other investors all chip in your money. Instead of bringing a casserole, you're bringing cash. A professional manager, the host of the party, takes all that money and goes shopping. They buy a whole bunch of different assets like stocks or bonds, creating one big diversified portfolio. You, in return, get a share of that entire potluck. You don't own the individual ingredients. You own a piece of the whole meal. It's a simple way to get instant diversification without having to buy dozens of different things yourself. Now, an ETF or an exchange-traded fund is like the high-tech cousin of the mutual fund. It's also a basket of assets, but with one crucial difference. You can buy and sell shares of an ETF on a stock exchange all day long, just like you would with a share of Apple or Tesla. The price fluctuates second by second, while a mutual fund's price is only calculated once at the end of the day. An ETF trades in real time. It's the difference between ordering from a daily menu versus picking items off a constantly moving conveyor belt. Both get you a diversified meal, but the delivery mechanism is different. Now, here's the most important part. These are just the containers. They're the vehicles. What really matters is what's inside them. And when it comes to gold, these vehicles primarily carry one of two things. This is the single most important distinction you need to understand, because choosing the wrong one can completely derail your investment strategy. First, you have funds that hold physical gold bullion. Let's be crystal clear about what this means. When you buy a share of one of these funds, you are buying a fractional, undivided interest in actual physical gold. We're talking about real heavy 400-ounce London Good delivery bars, stamped with serial numbers, sitting in ultra-high security vaults in places like London, Zurich, or New York. Imagine a vault bigger than a basketball court, with steel-reinforced concrete walls, 24/7 surveillance, and guards who look like they eat nails for breakfast. That vault is filled with stacks of gold bars worth billions of dollars. When you click buy on your brokerage account, a tiny microscopic piece of one of those bars is now legally yours. The fund's job is to buy the gold, arrange for its transport, pay for the insane level of security and insurance, and have it audited regularly to prove to you that it's actually there. Your share price is designed to track the price of gold, minute by minute. If the spot price of gold goes up 1%, the value of your share should go up almost exactly 1% minus a tiny fee. This fee is called the expense ratio. And it's the price you pay for the convenience of not having to store a 1,000-pound gold bar in your garage. For most people, it's a price well worth paying. This is the most direct, purest way to invest in gold without ever touching it. It's simple. It's clean. It's a pure play on the price of the metal itself. But there's a second, completely different way to play this game. And this is where the potential for explosive returns and heartbreaking losses comes in. I'm talking about funds that don't own a single ounce of gold. Instead, they own stocks in the companies that mine the gold. This is a totally different beast. You're no longer just betting on the price of gold. You're betting on a business. Think about it. You're investing in a collection of companies with massive earth-moving trucks, complex processing plants, thousands of employees, and geologists trying to figure out where the next big deposit is. You're investing in the CEOs and the management teams making multi-million-dollar decisions every single day. Why would anyone do this? Why add all this complexity? The answer is one of the most powerful and dangerous words in finance: leverage. The profits of a gold mining company are leveraged to the price of gold. Let me show you how this works, because understanding this concept is key. Let's imagine a mining company. We'll call it bedrock mining. Let's say it costs bedrock mining $1,500 to pull 1 ounce of gold out of the ground. That's their all-in sustaining cost. It includes everything from diesel for the trucks to the CEO's salary. Now, if the price of gold on the open market is $2,000 an ounce, bedrock mining makes a profit of $500 for every single ounce they sell. Pretty good. But watch what happens when the price of gold moves. Let's say the spot price of gold goes up by 10%, from $2,000 to $2,200. That's a nice but not spectacular move for the metal. But what happens to bedrock mining's profit? Their cost is still fixed at $1,500. But now, their revenue per ounce is $2,200. Their profit per ounce just went from $500 to $700. That's a 40% increase in profit from just a 10% increase in the gold price. The company's stock price could absolutely skyrocket as a result. That is the magic of leverage. Small moves in the underlying commodity can create massive swings in the profitability of the producer. This is why, during a gold bull market, gold mining stocks can massively outperform the price of gold itself. They can deliver returns of 2x, 3x, even 5x what the metal itself does. It's the ultimate high-octane way to invest in gold. But leverage is a double-edged sword. Cuts just as deep on the way down. Let's go back to our example. Gold is at $2,000, and bedrock mining is making $500 an ounce. Now, let's say the price of gold falls by 10%, from $2,000 down to $1,800. Again, a significant but not catastrophic drop for gold holders. But for bedrock mining, their costs are still $1,500. Their profit per ounce just cratered from $500 all the way down to $300. That's a 40% collapse in profitability from a 10% drop in the gold price. Their stock could get absolutely crushed. And if the price of gold were to fall below their $1,500 cost of production, they would be losing money on every ounce they dig up, and their very survival would be in question. And it gets even more complicated than that. Because you're investing in a business, you're exposed to all the risks that come with running a business. What if the CEO is a disaster and makes a terrible acquisition? What if their main mine is located in a country whose government suddenly decides to nationalize it and seize all the assets? That's called geopolitical risk, and it's very real. What if there's a mine collapse or a flood? That's operational risk. What if their geologists were wrong and the gold deposit they thought was there isn't? That's exploration risk. All of these things can destroy a mining stock's value, even if the price of gold is soaring. So you have these two powerful but very different tools. One is the physical gold fund. It's like a shield. It's a direct, simple, lower volatility way to protect your wealth against inflation and uncertainty. It moves with the price of gold. The other is the gold miners fund. It's like a spear. It's a leveraged, higher risk, more complex instrument designed for capital appreciation, with the potential for much, much higher returns. It's a bet on both the metal and the business. One is a safe haven, the other is a growth engine. So, how do you know which one is right for your portfolio? The shield or the spear? And more importantly, when you start looking at the hundreds of different funds out there, are there hidden traps and subtle details you need to watch out for when picking a specific one? That's where we're going next, and trust me, you don't want to miss the details that separate a smart investment from a costly mistake. Alright, let's pull back the curtain. The very first and arguably the most dangerous trap isn't some complex financial derivative or a hidden clause buried on page 97 of a prospectus. It's a single number. A number so small it seems insignificant, almost a rounding error. It's called the expense ratio, and it is the silent, relentless thief of your returns. Imagine you have two gold funds, Fund A and Fund B. Both are designed to do the exact same thing. Track the price of gold. You look at their performance and they seem identical, but then you look closer. Fund A has an expense ratio of 0.25%. Fund B has an expense ratio of 0.75%. You might think, 0.5%? What's the big deal? Over 1 year on a $10,000 investment, that's a difference of only $50. You might spend that on a nice dinner. But here's where the trap springs. That isn't a one-time fee. It's an annual fee skimmed off the top year after year after year. Compounds against you. Let's run those numbers over 20 years. Assuming a modest return, that $50 difference doesn't just become $1,000. Because of the magic of compound interest working in reverse, that insignificant 0.5% difference could cost you thousands, even tens of thousands of dollars in lost gains. It's a slow leak in your financial tire. You don't notice it day to day, but one day you wake up and find your portfolio is flat, while it should have been miles down the road. When it comes to funds that hold a physical commodity like gold, the expense ratio is even more critical. Why? Because the fund managers aren't performing complex stock analysis or identifying the next big tech company. For a fund that simply holds physical gold, their main job is to buy gold, stick it in a very secure vault, and make sure it stays there. The management is relatively simple. Therefore, the fees should be rock bottom. If you see a physical gold fund with a high expense ratio, that's a massive red flag. It's like paying a gourmet chef's salary to someone whose only job is to toast a piece of bread. You're paying for a service you simply aren't receiving. So rule number 1, scrutinize the expense ratio. Treat it like the most important number on the page because over the long term it very well might be. But let's say you find a fund with a razor-thin expense ratio. You're safe now, right? Not so fast. This brings us to the second, more subtle trap: tracking error. This sounds technical, but the concept is simple. A gold fund's job is to mirror the price of gold. If gold goes up 1%, your fund should go up almost exactly 1% minus the tiny expense ratio. It should be a perfect shadow of the real thing. Tracking error is what happens when that shadow gets distorted. It's when gold goes up 1%, but your fund only goes up 0.8%. Or worse, it goes down. You might think, how is that even possible? Well, a fund doesn't always have 100% of its assets invested in gold at every single second. There can be a small amount of cash held to pay for expenses or to handle investors buying in or selling out. This is called cash drag. Furthermore, the costs of buying and selling gold to meet that investor demand can create small deviations. A little bit of tracking error is normal, but a fund with a consistently high tracking error is a broken product. It's failing at its one and only job. How do you spot this? You don't just look at the fund's chart. You pull up a chart of the price of gold itself, the spot price, and you lay the fund's chart right on top of it. Over 1 year, 3 years, 5 years, do those two lines move in near perfect harmony? Or does the fund's line frequently lag, dip, or deviate from the real thing? If the shadow doesn't look like the object it's supposed to be tracking, you need to walk away. You're not buying gold. You're buying a poor imitation of it. Now, this is where the path splits and where the biggest, most fundamental misunderstanding occurs. This is the trap that catches more investors than any other, because it's not about a number, but about what you are fundamentally buying. You see, not all gold funds are the same. In fact, they can be two wildly different investments that just happen to share the word gold in their name. On one side, you have funds that own physical gold. They buy actual, real 100% gold bars, the kind you see in movies, and pay a third-party custodian like a major bank to store them in a high-security vault. When you buy a share of this fund, you are buying a direct fractional ownership of that physical gold. The value of your share is tied directly to the value of the gold in that vault. It's the purest, most direct way to invest in gold without having to buy a shovel and a safe for your basement. But on the other side of the path, you have a completely different beast: gold miner funds. These funds don't own any gold. Not a single ounce. Instead, they own stocks. Specifically, they own shares of the companies that dig gold out of the ground. companies like Newmont Mining, Barrick Gold, and dozens of smaller, more speculative exploration companies. And this is a critical distinction. Investing in a gold miner fund is not the same as investing in gold. You are investing in a business, a complex, risky, and often volatile business. And that business is subject to 1,000 variables that have nothing to do with the price of gold. Think about it. A mining company has to deal with labor strikes. Their multi-million-dollar piece of digging equipment could break down. A mine could flood. A government in the country where they operate could suddenly decide to nationalize the mine or jack up taxes. The price of diesel fuel, which they use in massive quantities, could skyrocket, crushing their profit margins. Their management team could make a series of terrible business decisions. Any one of these things can cause a mining stock to plummet, even if the price of gold is soaring. You could be right about gold going up and still lose a fortune. So why would anyone choose this path? For one simple, seductive word, leverage. Let's imagine a mining company can pull gold out of the ground for $1,000 an ounce. If the price of gold is $1,200 an ounce, they make a $200 profit on every ounce. Not bad. But what if the price of gold jumps 25% to $1,500 an ounce? Their cost is still $1,000, but their profit just jumped from $200 to $500. That's a 150% increase in profit from just a 25% increase in the price of gold. This leverage is why, during a gold bull market, mining stocks can dramatically outperform the metal itself. They can go parabolic, delivering absolutely life-changing returns. But leverage is a double-edged sword. If the price of gold falls from $1,200 to $1,050, a drop of just 12.5%, their profit gets cut in half from $200 to $50. A small dip in the price of gold can completely wipe out their profitability and send their stock price into a death spiral. So you have to ask yourself a fundamental question. Are you trying to own a stable store of value that hedges against inflation and crisis? Or are you trying to make a high-risk, high-reward bet on the profitability of a global industrial operation? The first one is an investment in physical gold. The second is an investment in gold miners. Confusing the two is like thinking you bought a government bond when you actually bought a lottery ticket. Both are made of paper, but their purpose and risk profile couldn't be more different. One is designed for preservation, the other for speculation. There's a place for both, but knowing which game you're playing is the most important decision you'll make. Now that we understand this crucial split between owning the metal versus owning the miners, we have to look at the wrapper these assets come in. Because you can access both of them through a traditional mutual fund, or through something else you've definitely heard of, an ETF or exchange-traded fund. They might seem similar on the surface, but the way they are structured, the way you buy and sell them, and the tax implications can be vastly different. And choosing the wrong one can be another one of those costly, silent mistakes. So, mutual fund versus ETF, what's the real difference and which one is right for you? Let's settle this debate with a simple analogy. Imagine you want to visit gold country. You have two main ways to get there and experience it. Option 1 is the guided bus tour. You buy one ticket for one price that's set at the end of each day. The bus leaves at a scheduled time, follows a predetermined route, and you sit back and enjoy the scenery. It's simple, it's reliable, and you don't have to worry about the details of navigation or traffic. This is your gold mutual fund. Option 2 is renting a car. You get the keys and you can drive wherever you want, whenever you want, as long as the roads are open. You can take scenic detours, stop for a photo on a whim, or race down the freeway to get to your destination faster. You're in complete control. The price of gas, however, is fluctuating constantly. This is your gold ETF or exchange-traded fund. Both will get you to gold country. Both allow you to experience the asset. But the journey, the control you have, the costs you'll encounter, and the flexibility you're afforded are worlds apart. And understanding this difference is the key to not getting stranded on the side of the road. Let's start with the biggest, most fundamental difference: how they are priced and traded. The gold mutual fund, our bus tour, has its price calculated only once per day, after the market closes. This price is called the net asset value, or NAV. It's the total value of all the gold and other assets the fund holds, divided by the number of shares. So, if you decide at 10 a.m. that you want to buy into the fund, you place your order, but you don't actually know the exact price you'll pay. You're essentially buying a ticket for that day's tour. And the final price for everyone who bought a ticket that day is settled after the closing bell at 4 p.m. Eastern Time. The same is true for selling. You decide to sell at 1 p.m., your order goes into a queue and you get the 4 p.m. closing price. This is beautiful in its simplicity. It forces you to be a long-term thinker. You can't panic sell during a midday dip, and you can't get greedy during a sudden spike. It removes the temptation of day trading and encourages a more disciplined, hands-off approach. It's perfect for people who want to set up automatic monthly investments and just let the fund do its work. Now let's grab the keys to the rental car, the ETF. Unlike the mutual fund, a gold ETF trades on a stock exchange just like a share of Apple or Tesla. This means its price is not set once a day. It's changing every second the market is open. You can see the price tick up and down in real time. If you see a news event that you think will send gold soaring at 11:03 a.m., you can log into your brokerage account and buy shares of a gold ETF at 11:04 a.m. If you think the price has peaked at 2:30 p.m., you can sell it instantly. This gives you an incredible amount of flexibility and control. You're the driver. You can react to the market with precision. You can use sophisticated trading strategies, like setting a stop-loss order to automatically sell if the price drops to a certain level, protecting your downside. You can't do that with a mutual fund. So for active traders or for investors who want that minute-to-minute control over their entry and exit points, the ETF is the undeniable winner. But that control comes with its own set of challenges. Remember the rental car? You have to pay for gas and you have to deal with traffic. In the world of ETFs, this translates to two critical concepts: commissions and the bid-ask spread. While many brokerages now offer commission-free trading on ETFs, it's not always the case. But the more important hidden cost is the bid-ask spread. This sounds complicated, but it's simple. The bid price is the highest price a buyer is willing to pay for a share right now. The ask price is the lowest price a seller is willing to accept. There is almost always a tiny gap between these two numbers, a few cents, maybe less. That gap is the bid-ask spread. It's the profit the market makers earn for providing the convenience of instant trading. Think of it as a tiny toll you pay every time you get on or off the freeway. For a long-term investor who buys a gold ETF and holds it for 5 years, this tiny toll is insignificant. But for an active trader who is buying and selling frequently, those little tolls can add up and eat into your profits. Just like driving a rental car all over the city will rack up gas and toll charges. With the mutual fund bus tour, there is no bid-ask spread. You buy at the NAV, you sell at the NAV. The price is the price. It's a simpler, more transparent transaction, even if it lacks immediacy. Next, let's talk about the cost of the vehicle itself, the ongoing fees known as the expense ratio. This is the annual fee the fund charges to cover its operating costs, like management, administration, and storing all that physical gold in a high-security vault. Historically, mutual funds were the expensive, luxury bus tours, and ETFs were the budget-friendly rental cars. ETFs often had significantly lower expense ratios. And while that's still generally true, the lines have blurred dramatically. Competition is fierce. We now have ultra-low-cost index mutual funds that can rival the fees of some ETFs. So you can't just assume ETF is always cheaper. You have to look at the specific expense ratio for the fund you're considering. It's like comparing the cost of a luxury tour bus to a high-end sports car rental versus a basic bus ticket and a compact car. You have to check the price tag on the specific model you want. Now for the last and perhaps most overlooked difference. It's a bit more technical, but it can have a huge impact on your real-world returns. I'm talking about tax efficiency. And here the ETF often has a massive structural advantage. Let's go back to our analogy. Imagine you're on the mutual fund bus tour. Halfway through the day, a bunch of passengers decide they want to get off and go home. To give them their money back, the tour guide, the fund manager, might have to sell some of the tour's assets. In our case, that means selling some of the fund's gold. If that gold has gone up in value since the fund bought it, selling it creates a capital gain. Here's the crazy part. That taxable capital gain is passed on to all the remaining passengers on the bus, even if you didn't sell a thing. At the end of the year, you could get a tax bill for gains you never personally realized just because other people left the fund. It's fundamentally unfair, but it's how many mutual funds work. Now let's look at the ETF rental car. The way ETFs are created and redeemed is different. It's a unique in-kind process with large institutional players. The simple way to understand it is this. When you sell your ETF shares, you're not selling them back to the fund company. You're selling them to another investor on the stock market. It's like selling your rental car contract to another driver. Because the fund manager rarely has to sell the underlying gold to pay off departing investors, these taxable capital gains events are far, far less common. The actions of other drivers don't trigger a tax bill in your glove compartment. This structural advantage makes ETFs, as a vehicle, generally more tax efficient for holding in a regular taxable brokerage account. So, after all that, which one is right for you? The mutual fund is for the set-it-and-forget-it investor. If you value simplicity above all else, if you want to make automatic, disciplined monthly contributions without having to think about it, and if you aren't tempted by the siren song of timing the market, the mutual fund is your steady, reliable bus tour. It's a fantastic choice for building a long-term position without the daily noise and complexity. The ETF is for the hands-on investor. If you want maximum control, the ability to react to market news in real time, and access to more advanced trading strategies, the ETF is your high-performance rental car. If you are cost-sensitive and want to take advantage of potentially lower expense ratios and greater tax efficiency in a taxable account, the ETF is an incredibly powerful tool. The choice isn't about which one is better in a vacuum. It's about which one is better for your investing style. Are you a passenger or are you a driver? Do you want a predictable, guided experience? Or do you want the freedom of the open road, with all the risks and rewards that come with it? Once you've answered that, you've chosen your vehicle. But now comes the next critical question. Just because you've decided between the bus and the car doesn't mean you know where you're going. Are all gold funds created equal? What's the massive difference between a fund that holds actual physical gold bars in a London vault and a fund that invests in the volatile stocks of gold mining companies all over the world? One is a direct play on the metal itself, the other is a bet on the businesses that dig it out of the ground. They behave in completely different ways, and choosing the wrong one can lead to some shocking surprises. Let's unpack those shocking surprises right now. To do that, we need to travel back in time. The year is 2011. The world is still reeling from the financial crisis. Central banks are printing money like there's no tomorrow. Fear is everywhere. And gold? Gold is the undisputed king. It hits a then-record high of over $1,900 an ounce. Investors who held physical gold or a fund that tracked it were celebrating. They had found the ultimate safe haven. Now, common sense would tell you that the companies pulling this precious metal out of the ground must have been having the party of a lifetime. If the price of your only product skyrockets, your business should be a rocket ship, right? Your stock price should be going to the moon. But that's not what happened. In the years that followed this peak, something deeply counterintuitive occurred. While the price of gold held relatively firm for a while before beginning a slow decline, the stock prices of major gold mining companies fell off a cliff. They didn't just dip. They collapsed. We're talking about drops of 70, 80, even 90% for some of the biggest names in the industry. Investors who had piled into gold miner mutual funds, thinking they were making a smart, leveraged bet on the price of gold, were absolutely annihilated. Their investment thesis, which seemed so logical, was shattered. So what on earth happened? How can the thing itself be valuable, while the people producing it go broke? This is the core difference, the great chasm between investing in gold and investing in gold miners. And it all comes down to one single concept: risk. A bar of gold sitting in a vault in London has one primary risk: that its price will go down. That's it. It's simple. A gold mining company, on the other hand, is a sprawling, complex beast of a business bleeding risk from 1,000 different cuts. Let's start with the most important one: operational leverage. This sounds like a fancy Wall Street term, but it's actually a simple and brutal concept. Imagine a mining company can dig up gold for a total, all-in cost of $1,500 an ounce. This includes everything: the fuel for the trucks, the salaries for the engineers, the electricity for the processing plant, everything. If gold is trading at $1,800 an ounce, the company makes a tidy $300 profit on every single ounce. Life is good. Now let's say the price of gold jumps by just 10% to $1,980. A nice move, but not earth-shattering. What happens to our company's profit? It doesn't go up by 10%. Their cost is still $1,500. Their new profit is $480 per ounce. That's a 60% increase in profit from just a 10% increase in the gold price. This is the magic of operational leverage. It's why investors get so excited about miners. It's a supercharged way to play the gold market. But leverage is a double-edged sword, and its other edge is razor-sharp. Let's say the price of gold falls by 10%, from $1,800 down to $1,620. What happens to the profit now? It shrinks from $300 an ounce down to just $120. A 10% drop in the price of gold caused a 60% collapse in their profitability. You can see how quickly this can spiral. If the price of gold falls below their $1,500 cost of production, they are losing money on every single ounce they pull from the earth. This is precisely what happened after 2011. Gold prices softened, but the cost of mining had ballooned during the boom years, and suddenly these companies saw their massive profits evaporate, turning into catastrophic losses. And that brings us to the second major risk, the costs themselves. That all-in sustaining cost I mentioned is not a fixed number. It's a moving target. The price of diesel fuel to run their massive haul trucks can skyrocket. Labor unions can go on strike, demanding higher wages and shutting down production for months. Governments can suddenly decide to levy a new tax or royalty, taking a bigger piece of the pie. These are all business risks, completely disconnected from the daily spot price of gold. A fund holding physical gold doesn't care about the price of diesel. A fund holding mining stocks is obsessed with it. Third, we have what is politely called geopolitical risk. That's a sanitized term for a very messy reality. Many of the world's richest gold deposits are not in nice, stable countries like Switzerland or Canada. They're in parts of Africa, South America, or Asia with a history of political instability, corruption, and civil unrest. A mining company can spend $1 billion developing a world-class mine, only to have a new government come to power and declare that the mine is now the property of the state. It's called nationalization. It happens. And when it does, the stock of that company can go to zero overnight, even if the price of gold is at an all-time high. The gold is still in the ground, it's still valuable, but the shareholders of that company no longer have any claim to it. A gold bar in a vault doesn't face the risk of a military coup. Fourth, there's management risk. Gold mining executives are human. They make mistakes. During the boom leading up to 2011, many of them made colossal ones. They took on mountains of debt to buy rival companies at inflated prices. They chased growth at any cost, developing low-quality, high-cost mines that were only profitable when gold was at its absolute peak. When the price fell, they were left with crushing debt payments and unprofitable holes in the ground. Their decision-making, their hubris, destroyed billions in shareholder value. A fund holding physical gold doesn't have a CEO who can make a disastrous multi-billion-dollar acquisition. Its value is pure. It's not dependent on the judgment of a handful of people in a boardroom. Finally, there's the simple geological fact of depletion. A mine is a finite resource. Every ounce of gold that's taken out is one less ounce that's left. This means a mining company is in a constant, desperate race against time. They have to spend enormous sums of money on exploration, drilling thousands of holes in remote locations, just to find new deposits to replace what they're mining. Exploration is expensive and it's often a failure. They can spend hundreds of millions of dollars and find nothing. This constant need to find and build new mines is a massive, ongoing cost that a bar of gold simply doesn't have. It doesn't deplete. It doesn't need to be replaced. So when you buy a gold miners mutual fund, you're not just betting on the price of gold. You are buying a basket of all these risks. You're betting on the skill of the managers to control costs, the stability of the governments where they operate, the wisdom of the executives in the C-suite, and the luck of the geologists in the field. Sometimes all of those things align, and the operational leverage works its magic, delivering returns that can dwarf the performance of physical gold. But as history has shown us, when those things go wrong, the results can be devastating, turning a golden opportunity into a portfolio nightmare. Understanding this distinction is the single most important step in deciding how you want to add gold to your portfolio. It's not just a choice between Fund A and Fund B. It's a choice between two fundamentally different philosophies. Are you seeking the relative simplicity and purity of the metal itself, a direct hedge against currency debasement and financial turmoil? Or are you a speculator, willing to take on the immense risks of the mining business, in the hopes of capturing the immense rewards of its leverage? The answer to that question will guide every decision you make from here on out. So you've looked in the mirror. You've answered the question. You know whether you're building a fortress or prospecting for a fortune. This single piece of self-knowledge is the most important compass you will ever own in the world of gold investing, because the path of the hedger and the path of the speculator, while they may both lead through golden territory, are two wildly different journeys. Let's walk the first path, the path of the hedger. Your goal is preservation. Your enemy is chaos. You aren't trying to get rich off of gold. You're trying to prevent everything else you own from making you poor. You want your gold investment to behave like gold. Pure, simple, and direct. When the price of an ounce of gold goes up 1%, you want your investment to go up 1%. When it goes down, you want it to go down in lockstep. You want a mirror, not a magnifying glass. For you, the ideal vehicle is a mutual fund that aims to directly track the price of gold. These are often called bullion funds, or precious metals funds, that focus specifically on holding the physical metal itself. Now, a mutual fund company isn't going to mail you a gold bar. Instead, they do one of two things. They either buy and store enormous quantities of physical gold bullion in a secure vault, like at a major bank in London or New York, or they invest in gold-backed securities and futures contracts that are directly tied to the spot price. The beauty of this approach is its purity. You are effectively owning gold without the headache of finding a secure place to store it, insuring it, and then finding a reputable dealer to sell it to when the time comes. The fund handles all of that. You buy a share of the fund, and you own a fractional, undivided interest in a massive pile of gold bars sitting in a vault somewhere. It's the closest you can get to the real thing in your brokerage account. The appeal is primal. In a world of digital promises and complex derivatives, this is an investment you can understand on a gut level. It's a claim on a real, tangible, finite asset that has been a store of value for 5,000 years. When you invest this way, you are not betting on a CEO's strategy or a company's quarterly earnings. You are making a single, clean bet that in the face of uncertainty, the value of this ancient metal will endure. But this purity comes at a cost. And this is a critical point that many investors miss. A fund that holds physical gold is, by its very nature, a non-productive asset. A gold bar sitting in a vault doesn't innovate. It doesn't create a new product. It doesn't pay a dividend. In fact, it does the opposite. It costs money to store. It costs money to insure. It costs money to manage. These costs are passed on to you, the investor, in the form of an expense ratio. Think of it like an insurance premium. Every year, a small percentage of your investment is shaved off to pay for the upkeep of your financial fortress. If gold's price stays perfectly flat for a year, your investment will actually be down by the amount of that expense ratio. You are paying for the privilege of protection. For the hedger, this is a perfectly acceptable trade-off. You don't complain about paying for homeowners insurance just because your house didn't burn down this year. The cost buys you peace of mind, but you must go into it with open eyes, understanding that this is a defensive asset, and defense always has a cost. Now let's leave the quiet, sturdy fortress of the hedger and walk the other path. The path of the speculator. This path is not a quiet, paved road. It's a treacherous mountain trail with breathtaking views and terrifying drop-offs. You aren't looking for a mirror to the gold price. You want a lever. You believe gold is going up, and you want to magnify that move to its absolute maximum potential. You aren't buying insurance. You're buying a lottery ticket with astonishingly good odds, if your timing is right. For you, the vehicle of choice is a mutual fund that invests in the stocks of gold mining companies. And this is where everything changes. You are no longer investing in a simple, inert metal. You are investing in a complex, messy, high-stakes business. The magic word here is leverage. Operational leverage. It's the entire reason these funds exist. Let me paint you a picture. Imagine a mining company. Let's call it Summit Gold. It costs Summit Gold $1,500 all in to pull 1 ounce of gold out of the ground. The price of gold today is $2,000 an ounce. So, for every ounce they sell, they make a $500 profit. Now, you, the speculator, believe the price of gold is about to surge. And you're right. The gold price rises by just 10%, from $2,000 to $2,200 an ounce. What happens to Summit Gold's profit? Their cost is still $1,500. But now their revenue per ounce is $2,200. Their profit has jumped from $500 to $700. A 10% increase in the price of gold created a 40% explosion in the company's profit per ounce. That is leverage. And as their profits soar, their stock price is likely to soar by an even greater amount. This is the immense reward. But leverage is a double-edged sword. Cuts just as deeply on the way down. What if the price of gold falls by 10%, from $2,000 to $1,800? Their cost is still $1,500. Their profit collapses from $500 to just $300. That same 10% move in gold just wiped out 40% of their profit. This is the immense risk. And that's only the beginning of your worries. As a mining stock investor, the price of gold is just one of a dozen things that can go wrong. You are exposed to a universe of risk that the bullion hedger never even thinks about. There's geopolitical risk. The world's richest gold deposits are often located in politically unstable countries. A new government could come to power and decide to nationalize the mines. essentially seizing the company's most valuable asset. A change in tax law or environmental regulations could turn a profitable mine into a money pit overnight. There's operational risk. Mining is one of the most difficult industrial operations on the planet. Mine shafts can flood. Critical machinery can break down. Geologists can be wrong about the quality of the ore in the ground. Labor unions can go on strike, halting production for months. You could be perfectly right about the price of gold, but if the company you invested in can't get the metal out of the ground, it doesn't matter. And then there's management risk. Is the executive team a group of world-class geologists and sharp-penciled accountants, or are they reckless promoters who are better at selling stock than they are at finding gold? A bad management team can destroy a company with a great asset by taking on too much debt, or by constantly diluting existing shareholders to fund their bloated salaries. When you buy a gold mining mutual fund, you aren't just buying gold. You're buying a portfolio of these complex businesses. You are, in effect, hiring a fund manager to be your expert. You're paying them to fly to remote locations in South Africa or Peru, to walk the mine sites, to stress test the engineering plans, and to grill the CEO on their 5-year strategy. You are outsourcing the incredibly difficult task of navigating this minefield to a team of professionals. So you see the two roads laid out before you. The fortress of the hedger, built on the simple, powerful foundation of physical gold, and the minefield of the speculator, a landscape of incredible danger and potentially life-changing rewards. Each path serves a completely different purpose, and many funds you'll find are actually a hybrid, holding a core position in bullion alongside a basket of carefully selected mining stocks, trying to capture the best of both worlds. But knowing the map is one thing. Choosing the right vehicle to travel that road is another entirely. How do you look under the hood of a specific gold fund and tell if it's a finely tuned machine, or a lemon waiting to break down on the side of the road? How do you decipher the jargon, compare the costs, and spot the hidden red flags? That's where we go next. Alright, let's grab our tools and pop the hood. The first thing you need to find is the fund's prospectus. Think of this as the owner's manual. Now I know what you're thinking. A prospectus? Isn't that a 100-page document written in pure, undiluted legalese designed to put you to sleep? And yes, you're not wrong. But buried in that dense text are the 3 most important sections you need to read, and they're usually right at the beginning in a section called the summary prospectus. First, look for the investment objective. This is the fund telling you in plain language what it's trying to accomplish. It might say something like, the fund seeks to reflect the performance of the price of gold bullion. Simple, direct. Or it might say, the fund seeks long-term capital appreciation by investing in companies engaged in the gold industry. See the difference? One is trying to be gold, the other is trying to profit from the business of finding and selling gold. This single sentence is your North Star. Everything else the fund does must align with this objective. If it doesn't, that's your first major red flag. Second, right next to it, you'll find the principal investment strategies. This is the how. If the objective is the destination, the strategy is the GPS route it plans to take. This section tells you what the fund will actually buy. Will it buy physical gold bars and store them in a vault in London? Will it buy stocks of major mining corporations like Newmont or Barrick Gold? Or will it use complex financial instruments like futures contracts and options? This section is non-negotiable reading. A fund whose objective is to track the price of gold, but whose strategy involves buying small, speculative junior mining stocks in unstable countries, is a potential lemon. The strategy must be a logical way to achieve the objective. And third, you need to find the principal risk section. This is the car manufacturer telling you the airbags might not work under certain conditions. Every investment has risks, and gold funds are no exception. For a physical gold fund, the risk is simple: the price of gold goes down. But for a gold miners fund? Oh, the list is much longer. You'll see risks like management risk, meaning the CEO could make a terrible decision. Regulatory risk, meaning a government could change its mining laws overnight. Geopolitical risk, meaning a mine could be in a country that suddenly has a revolution. Reading this section isn't about scaring yourself. It's about understanding what you're signing up for. It's about knowing the difference between the risk of a flat tire and the risk of the engine exploding. Once you've read the owner's manual, the next step is to check for leaks. The single most corrosive, performance-destroying leak in any mutual fund is its expense ratio. This is the annual fee the fund company charges to manage your money, expressed as a percentage of your investment. It might sound small, maybe 0.5%, 0.75%, or even 1.5%. But do not be fooled by the tiny number. The expense ratio is a silent killer. It's like a tiny hole drilled in the bottom of your gas tank. You never see the fuel dripping out, but every single day you're losing a little bit of your money. And over 10, 20, or 30 years, that tiny leak can drain a shocking amount of your potential returns. Let's put it in perspective. Say you invest $10,000. A fund with a low expense ratio of 0.4% will cost you $40 a year. A fund with a high expense ratio of 1.4% will cost you $140 a year. $100 difference, no big deal, right? Wrong. That fee is charged on your entire balance year after year. As your investment grows, the fee grows with it. Compounded over decades, the difference between a low-cost and a high-cost fund can be tens of thousands, even hundreds of thousands of dollars. It's the single greatest predictor of future fund performance. Yes, you heard that right. Not the star manager, not the past returns, the cost. So what's a good number? For a simple gold fund that just holds physical bullion or tracks a gold index, anything over 0.5% should be viewed with extreme suspicion. The job is simple, so the cost should be low. For an actively managed fund that invests in gold mining stocks, where a team of analysts is supposedly doing deep research, you can expect to pay more. But even there, once you start creeping up towards 1% and beyond, the fund manager has to be a true wizard to justify that cost. They have to consistently beat their competitors not just by a little, but by enough to cover their higher fee. And the data shows year after year that very few of them ever do. You find the expense ratio right there in the prospectus, clear as day. It's the price tag on the car. Don't even think about buying until you know what it is. Now we move from the paperwork to the engine itself, the fund's holdings. What is this machine actually made of? You need to look at the fund's top 10 holdings, which is usually listed on the fund's website or on financial data sites like Morningstar. This is where the truth comes out. This tells you if the fund is practicing what it preaches in its prospectus. If you're looking at a physical gold fund, the holdings list should be pretty boring. It might just say gold bullion. Perfect. That's what you want. But if you're looking at a gold miners fund, this is where you become a detective. Are the top holdings large, stable, profitable companies, or are they small, speculative exploration companies that have never poured an ounce of gold? Is the fund diversified across different companies in different countries, or is it making a huge, concentrated bet on one or two miners? A fund that calls itself a global gold fund, but has 75% of its assets in Canadian mining stocks isn't really global, is it? This is also where you spot style drift. That's a fancy term for a fund manager who starts chasing performance outside of their stated strategy. You might see a gold fund that suddenly has a large position in silver companies, or even copper or lithium miners. The manager might be thinking, hey, electric vehicle batteries are hot right now, let's buy some lithium stocks. But that's not what you paid them for. You bought a gold fund for exposure to gold, not to the manager's flavor of the month stock picks. Looking at the top holdings ensures the engine parts match the blueprint in the owner's manual. If they don't, walk away. Next, we need to check the performance history, the track record. But here's a critical secret. Looking at a fund's returns in isolation is completely useless. A fund that returned 15% last year sounds amazing, right? But what if the price of gold itself went up 20%? In that case, your amazing fund actually underperformed its goal by a whopping 5%. Failed. This is why you must always compare a fund's performance to its benchmark. A benchmark is a standard, an index that represents the market the fund is competing in. For a physical gold fund, the benchmark is the spot price of gold. For a gold miners fund, it might be an index like the NYSE Arca Gold Bugs Index. You want to see how the fund has performed against this benchmark over multiple time periods: 1 year, 3 years, 5 years, and 10 years. One good year could be luck. But a fund that has consistently beaten its benchmark over 5 or 10 years, after accounting for its expense ratio, is demonstrating skill. Conversely, a fund that consistently lags its benchmark is a lemon. You are paying a manager for their expertise, and if they can't even keep up with a simple, unmanaged index, what exactly are you paying for? This data prevents you from being seduced by a big, flashy number from a single year and forces you to ask the tougher, more important question. How did you perform relative to what you were supposed to do? Finally, let's look at the driver, the fund manager. While less critical for a simple index fund, in an actively managed fund, the person or team making the decisions is paramount. Look for manager tenure. How long has the current manager been running this fund? If they have a great 10-year track record, but the manager who achieved it left 6 months ago, that track record is irrelevant. The new driver could be a prodigy or a disaster. You simply don't know. A long tenure of, say, 10 years or more means you're looking at the track record of the person who is still in the driver's seat. This 5-point inspection, checking the prospectus, the expense ratio, the holdings, the performance versus a benchmark, and the manager tenure is your toolkit. It's how you move from being a passive passenger to an informed owner. It transforms a wall of confusing data into a clear, simple checklist. Is the objective clear? Is the cost low? Are the holdings aligned? Is the performance consistent? Is the manager experienced? By answering these questions, you can confidently distinguish between a well-built investment vehicle designed for the long haul and a flashy lemon that's all marketing and no substance. But now that you know how to pick the right fund, an even bigger question emerges. How does this specific asset, gold, actually fit into your overall financial plan? How much should you own? And what is its true purpose in a modern diversified portfolio? That's the strategic blueprint we'll lay out next. So let's build that blueprint. Think of your portfolio not as a collection of stocks and funds, but as a high-performance engine. For most of us, that engine is built for one thing: growth. It's powered by stocks, by innovation, by the relentless forward march of the economy. It's designed to be powerful, to be fast, and to compound your wealth over time. But every high-performance engine has a critical, often overlooked, component: a cooling system, a fail-safe. Something that keeps it from overheating and seizing up when the pressure gets too intense. In the world of finance, for many sophisticated investors, that fail-safe is gold. The first question everyone asks is, okay, so how much? You'll hear numbers thrown around constantly. 5%, 10%. Some gold enthusiasts might even scream 20% or more. But these numbers are meaningless without context. It's like a doctor prescribing a dosage without first diagnosing the patient. The right allocation for you depends entirely on what you're trying to achieve, what you're afraid of, and the composition of the rest of your portfolio. The how much is the last question you should ask. The first question is always, why? What is gold's specific job description in your financial life? Gold really only has two primary jobs in a modern portfolio, and neither of them is to make you rich. That's the job of your stocks, your real estate, your business. If you're buying gold hoping it will triple in value next year, you're using the wrong tool for the job. You're using a shield as a sword. Its first and most important job is to be your portfolio's insurance policy against chaos. Think about the insurance you have on your house. You pay a premium every single year, and for most of your life you get absolutely nothing back for it. Feels like a waste of money, but you don't cancel it. Why? Because you aren't paying for a return. You're paying to protect yourself from a low probability, but catastrophic event. A fire, a flood, an event that could wipe you out completely. Gold is your portfolio's fire insurance. It's a hedge against systemic risk. This isn't just about a stock market crash. We have bonds for that, usually. This is insurance against something deeper. It's a hedge against a currency crisis, where the value of the dollar itself comes into question. It's a hedge against runaway inflation that the Federal Reserve can't control. It's a hedge against geopolitical meltdowns where faith in governments and their financial systems begins to evaporate. In those moments when the systems we rely on are shaking, gold's ancient role as a store of value, beholden to no government or central bank, comes to the forefront. Like that fire insurance, you might go years, even a decade, where it just sits there, seemingly underperforming your exciting tech stocks. And then one day the fire starts, and you will be profoundly grateful you paid the premium. Its second job is to be a stabilizer. A ballast in the ship. This comes down to a simple but powerful concept: correlation. Or in gold's case, a lack thereof. Historically, gold has had a very low, and sometimes negative correlation to stocks and bonds. This just means it doesn't move in the same direction at the same time. When stocks are soaring in a bull market, gold might be flat or even down. Feels like dead weight. But when stocks are plummeting in a panic, gold often does the opposite. It zags when the market zigs. Think back to the financial crisis of 2008. From late 2007 to early 2009, the S&P 500 was absolutely decimated, losing over 50% of its value. It was a bloodbath. But during that same period, gold was up. Not by a huge amount, but it was a rock of stability in a sea of red. Having even a small 5 or 10% allocation to gold wouldn't have saved you from losses, but it would have cushioned the blow. It would have reduced the overall volatility of your portfolio, making the downturn less terrifying and, crucially, making it psychologically easier for you to stay invested and not panic sell everything at the bottom. It smooths the ride. And a smoother ride is an easier ride to stay on for the long haul. So, with those two jobs in mind, insurance and stabilizer, we can finally circle back to the real question. How much? Let's build a framework for you to decide. Comes down to 3 key variables. First, your age and your time horizon. A 25-year-old with 40 years until retirement has an immense capacity to take risks. A market crash for them is a buying opportunity. Their primary goal is aggressive growth. For this person, the need for a large insurance policy is lower. A smaller allocation, perhaps in the 2 to 5% range, makes a lot of sense. It's enough to provide some diversification benefits without sacrificing too much potential upside from stocks. On the other hand, consider someone who is 65 and just retired. Their entire game has changed. They are no longer in the wealth accumulation phase, they are in the wealth preservation phase. A 50% drop in their portfolio is not a buying opportunity. It is a life-altering catastrophe. For this person, the insurance and stability that gold provides are far more valuable. A larger allocation, maybe in the 7 to 15% range, could be much more appropriate. They are willing to trade some potential growth for a lot more peace of mind and downside protection. Second, your personal economic outlook and conviction. This is where you have to be honest with yourself. How much do you trust the current financial system? Are you someone who believes that, despite the bumps, the government and the Federal Reserve will generally keep things on track? Or are you deeply concerned about the national debt, unfunded liabilities, and the long-term prospect of currency debasement through endless money printing? There is no right or wrong answer here, but your answer should influence your allocation. If you fall into the more optimistic camp, a smaller, purely diversification-focused allocation is logical. If you find yourself in the more skeptical camp, and you believe the systemic risks are higher than the market is pricing in, then a larger allocation to gold as a primary insurance asset is a rational expression of that worldview. Your portfolio should reflect your convictions. And third, the composition of your existing portfolio. Gold is not the only alternative asset. What else do you own? If your portfolio is a standard 60-40 mix of US stocks and bonds, you have very little that is truly uncorrelated. In this case, adding a 5 to 10% slice of gold introduces a powerful new dimension of diversification. However, if you're a real estate mogul with 70% of your net worth in physical properties, you already have a massive inflation hedge. Your need for gold might be lower. If you're heavily invested in other commodities like oil or industrial metals, the same logic applies. You have to look at gold not in a vacuum, but as a potential team member on a team you've already built. Does it fill a role you currently have vacant? For most people invested solely in paper assets like stocks and bonds, the answer is a resounding yes. So let's put it all together. Imagine a 40-year-old investor. She has a 25-year time horizon, so she's still focused on growth, but she's starting to think more about wealth preservation. She's moderately concerned about inflation and government debt, but not a full-blown doomsayer. Her portfolio is a simple mix of an S&P 500 index fund and a total bond market fund. For her, a baseline allocation of around 5 to 8% to a gold mutual fund would be a very reasonable starting point. It's not so large that it will dramatically drag down her returns during a long bull market, but it's significant enough to provide that meaningful insurance and stabilization when the next crisis inevitably hits. She can then adjust it up or down from there based on her evolving circumstances and convictions. This isn't about market timing, it's about strategic allocation. You don't buy home insurance because you think your house is going to burn down next Tuesday. You own it consistently for the protection it provides. The same is true for gold. You decide on your strategic allocation, you implement it, and then you rebalance perhaps once a year to maintain that target. Now we've established the why and the how much. We've built the strategic blueprint. But this brings us to the most crucial practical step of all. Once you've decided on your percentage, how do you actually execute this? Which specific gold mutual fund do you choose from the dozens available? This is where the rubber meets the road, and it's where most investors make catastrophic mistakes. Choosing the wrong fund can mean paying outrageous fees, suffering from poor tracking, or even getting hit with unexpected tax bills that silently eat away at your returns for decades. The difference between a great gold fund and a terrible one has nothing to do with the gold itself. It's all in the fine print. And in the next part, we are going to tear that fine print apart. We'll show you exactly what to look for, the hidden traps to avoid, and how to select the single best vehicle to execute your new gold strategy. Alright, let's open the vault. You've decided gold is your move, but choosing the right fund is like walking through a minefield blindfolded. One wrong step and your strategy is toast. The documents they give you, the prospectus, the fact sheet, they're not designed for you to understand. They're designed to protect them. But we're going to flip that script. We're turning their legal shield into your investor sword. Let's start with the most common choice. The big physical gold ETFs. Think of funds like GLD or IAU. Their promise is simple. You buy a share, they buy the gold. Supposed to be a one-to-one link. The first thing everyone tells you to look at is the expense ratio. And they're right, but they're only scratching the surface. The expense ratio is the yearly fee the fund charges to manage the assets. For GLD, it might be 0.4%. For IU, it might be 0.25%. You might think, what's 0.15%? It's nothing. But that's the slow bleed. Over 10-20 years, that tiny difference compounds into thousands of dollars of your money that you've given away for nothing. It's the first and easiest trap to avoid. Lower is almost always better. But that's child's play. The real danger isn't the fee you can see. It's the risk you can't. Buried deep in that 100-page prospectus is the section on custody of gold bullion. This is the multi-trillion-dollar question. Who holds the gold and how do they hold it? Most of these large ETFs use a custodian, a massive bank like HSBC or JP Morgan, to store the gold bars in a London vault. Here's where it gets murky. You need to look for two critical words: allocated versus unallocated. Allocated means specific bars with specific serial numbers are set aside in your name, or rather, in the fund's name on behalf of all shareholders. It's like having a key to a specific safe deposit box. Unallocated is different. It's more like a coat check ticket. You gave them a coat and they owe you a coat back, not necessarily your coat. Your gold is pooled with everyone else's. In a crisis, this becomes a monumental risk. Most of these funds hold the gold on an allocated basis, which is good. But the fine print often reveals a terrifying exception. They can use subcustodians. And those subcustodians might not have the same standards. And there's more. The prospectus will state that you, the individual shareholder, have no right to take physical delivery. You can't just show up in London and ask for your ounce of gold. You own a paper claim, a promise. You're betting that in the exact moment you need that insurance to pay out, the system that issued the paper will be perfectly intact. For many, that's a risk that defeats the entire purpose of owning gold. So maybe you think, I'll get clever. I'll buy the miners. They pull the gold out of the ground. That's a leveraged play. If gold goes up 10%, the miners could go up 50%. And you're not wrong. That can happen. But you're not buying gold anymore. You're buying a company. A company with a CEO, a board of directors, employees, and a whole world of problems that have nothing to do with the price of gold. When you look at the fine print of a gold miners ETF like GDX, you're not looking for custody details. You're looking at the holdings. You'll see names like Newmont Barrick Gold. You are now exposed to something called management risk. A brilliant CEO can make a company soar, but a terrible CEO can run it into the ground. Even if gold is at $10,000 an ounce, they can make a bad acquisition, take on too much debt, or completely mismanage a project. Your investment gets wiped out while the price of gold, the very thing you wanted exposure to, is skyrocketing. Then there's political risk. Look at where these companies operate. Many of the world's richest gold deposits are in politically unstable regions of Africa, South America, or Asia. A new government can get elected and decide to nationalize the mines. They can jack up taxes to punitive levels. They can shut down operations over environmental concerns. Suddenly, that company's most valuable asset is worthless, and your stock plummets. This isn't a hypothetical. It happens all the time. And finally, there's good old-fashioned operational risk. Mining is a brutal, dangerous, and complex business. Mines can flood. Tunnels can collapse. Equipment can break. The geological surveys could be wrong, and the ore grade might be far lower than they projected. All of these things crush profitability and have zero correlation with the spot price of gold. Buying a miner fund isn't a safe haven. It's a high-risk, high-reward bet on a notoriously volatile sector of the stock market. It's a speculation, not insurance. So what's left? The actively managed precious metals mutual fund. This is where you pay a genius fund manager a hefty fee, often over 1%, to navigate this world for you. They'll pick the best miners, maybe hold some physical gold, and time the market. The promise is that their expertise is worth the price. The first trap in the fine print here is obvious. that high expense ratio. You are starting in a hole. The fund has to outperform its low-cost passive ETF competitors by more than its fee, year after year, just for you to break even. And historical data shows that the vast majority of active managers fail to do this over the long term. But the more insidious trap is strategy drift. You buy the Global Gold and Precious Metals Fund, thinking you're getting gold. But you dig into the prospectus, and you find the manager has a mandate that allows them to invest up to 25% in industrial metals like copper and zinc. Or they might decide silver is the better play and shift a huge portion of the fund into silver miners. You thought you were buying a specific thesis, gold as a hedge, but you actually bought a bet on one person's ever-changing opinion of the entire global commodities market. The fund you bought is not the fund you end up owning 6 months later. You've given up control, you're paying a fortune for it, and you might not even be getting the exposure you wanted in the first place. So where does that leave us? Sounds like every option is flawed. The physical ETFs have counterparty risk. The minor ETFs have business and political risk. The active funds have fee and strategy risk. It's a minefield. But this is where clarity emerges. You have to match the vehicle to your goal. Be brutally honest with yourself. Why are you buying gold? If your answer is, I want a simple, liquid, low-cost way to track the price of gold for short to medium-term trading, and I trust the banking system will remain intact, then a low-cost physical gold ETF like IU is probably your most logical tool. Acknowledge the risks but accept them for the convenience. If your answer is, I have a high risk tolerance, I've done my research, and I believe gold mining stocks are fundamentally undervalued and will provide explosive, leveraged returns as the gold price rises, then a miners ETF like GDX or GDXJ is your weapon of choice. Just don't you dare call it a safe haven. It's a race car, not a bomb shelter. But what if your goal is the original thesis we've been exploring? What if you want true long-term insurance? What if you want to own gold as a hedge against the very system that issues those ETFs? What if you want to minimize counterparty risk, eliminate management and political risk, and avoid the high fees and whims of an active manager? That requires a different kind of vehicle entirely. It's a choice that sits in a brilliant sweet spot between all these flawed options. It's an approach that gives you a much purer claim on gold itself, often at a discount to its market value, while still providing the growth potential of a business. It's the choice the smartest, most sophisticated gold investors in the world, people like Rick Rule and Doug Casey, have championed for decades. And in the final part of this series, we are going to pull back the curtain on this exact strategy. We'll reveal the one vehicle that just might be the single best way to own gold. It's a vehicle that attempts to solve the gold investor's trilemma, the conflict between security, liquidity, and cost. For decades, you had to choose. You could have physical gold in your hand, that's ultimate security, but it wasn't liquid and came with storage costs and risks. Or you could have a paper derivative like an ETF that's ultimate liquidity, but you sacrifice the security of direct ownership, inviting layers of counterparty risk. You were always compromising. So what if you didn't have to? What if you could construct the perfect gold investment from the ground up? Let's build it. First, it would have to represent direct, unencumbered ownership of real physical gold. Not a promise of gold, not a derivative tied to the price of gold, but actual ownership of specific, allocated bullion. Each share you buy would need to correspond to a real, tangible slice of a gold bar with a serial number, sitting in a vault. This is non-negotiable. It eliminates the primary fear associated with paper gold, that in a crisis the gold simply won't be there. Second, this vehicle would need to be stored in the most secure, professionally managed, and regularly audited vault on the planet. Not in your basement, not in a safe deposit box tied to a bank that could declare a bank holiday, but in a world-class facility, fully insured, and located in a jurisdiction known for its stability and respect for property rights. This removes the personal risk and headache of self-storage. Third, it must be highly liquid. You need to be able to buy or sell your stake in this gold instantly, with the click of a button, during market hours. It should trade on a major stock exchange just like a share of Apple or Microsoft. This gives you the flexibility that bullion coins and bars simply can't offer. You can get in or out of your position in seconds, not days. Fourth, and this is the absolute game changer, there must be a mechanism for physical redemption. If you accumulate enough shares, you should have the legal right to trade them in and have the actual physical gold bars delivered to you. Now, most people will never do this, but the option to do so is the ultimate disciplining mechanism. It's the feature that guarantees the entire structure is honest. It proves the gold is real, it's there, and it's yours. It keeps the share price tethered to the real-world value of the metal it represents. And finally, for a U.S. investor, it would ideally offer a more favorable tax treatment. As we've discussed, physical gold and most ETFs are taxed as collectibles by the IRS, which means long-term gains are taxed at a punishing 28%. Our ideal vehicle would qualify for the much lower long-term capital gains tax rate, which is typically 15 or 20% for most people. That difference is massive over time. So we have our checklist: direct physical ownership, elite security, stock market liquidity, a redemption feature, and better tax treatment. For years, this combination sounded like a fantasy, but it exists. And it's not a traditional mutual fund, nor is it one of the giant bank-sponsored ETFs that dominate the headlines. The vehicle that ticks all these boxes is a specific type of investment structure: a closed-end physical bullion trust. The most prominent and well-regarded example for U.S. investors is the Sprott Physical Gold Trust, which trades on the New York Stock Exchange under the ticker symbol PHYS, or PHYS. Let's be clear, this isn't a sponsored recommendation, but an educational breakdown of a structure that uniquely solves the problems we've spent this entire series exploring. And PHYS is the best-in-class example. So how does it work? Unlike an ETF like GLD, which is structured as a grantor trust subject to that collectibles tax rate, PHYS is structured as a passive foreign investment company, or PFIC, under U.S. tax law. Now that sounds complicated and scary, but with a simple election on your tax forms, it allows long-term gains to be treated as qualified capital gains, not collectibles. That single structural difference could save you thousands or tens of thousands of dollars in taxes over the life of your investment. It's a monumental advantage, but the real magic is in the ownership and security. When you buy a share of PHYS, you are buying a direct fractional interest in physical London good delivery bars. The gold is held in your name, fully allocated. It is not part of the trust's assets that a creditor could claim in a bankruptcy. It is your gold. It is stored at the Royal Canadian Mint, a crown corporation of the Canadian government, renowned for its security. It's outside the U.S. banking system, which for many investors seeking a hedge against systemic risk, is a feature, not a bug. And that redemption feature? It's the bedrock of the trust. Any unit holder who accumulates enough shares to equal the value of a full London good delivery bar, we're talking hundreds of thousands of dollars here, can submit a redemption request and take physical delivery. Again, you probably won't do this, but the fact that hedge funds, institutions, and high-net-worth investors can and do perform this arbitrage ensures that a share of PHYS will always trade very close to its net asset value, the actual market price of the gold it holds. It's the ultimate proof of reserves. You can't redeem a paper promise from a COMEX warehouse that's been leased and released 10 times over. With PHYS you can. Let's put this all together and compare it to the other options. You want to buy $10,000 of gold. You could buy physical coins. You get the security of holding it, but you'll pay a high premium over the spot price. You have to figure out how to store it safely. And when you sell, it's illiquid and you'll likely sell at a discount. Plus, you'll face that 28% collectibles tax on any gains. Or, you could buy $10,000 of a standard gold ETF like GLD. You get great liquidity and the price is very close to spot. But you don't own the gold. You own a share in a trust that owns the gold, with layers of custodians and subcustodians. Your claim is that of an unsecured creditor, and you have absolutely no right to redeem it for physical metal. And you're still stuck with the 28% collectibles tax. Now, consider $10,000 of PHYS. You get the same stock market liquidity as GLD. You are the direct, beneficial owner of the physical gold, held securely outside the banking system. The redemption feature keeps the whole system honest. And your long-term gains are potentially taxed at the much lower 15 or 20% capital gains rate. You get the best of the physical world, true ownership and security, combined with the best of the paper world, liquidity and ease of transaction, all wrapped in a more tax-efficient package. It is, for many, the closest thing to a perfect solution. This entire series has been a journey. We started by asking a simple question: should gold be part of your portfolio? We explored its history as money, its role as a crisis hedge, and the macroeconomic storms that are brewing today that make its case more compelling than ever. We dissected the different ways to own it, from the shovels of the miners to the futures contracts of the speculators. We peeled back the layers of the popular ETFs and exposed the risks hidden in their fine print. And we've arrived here. at a conclusion that isn't about a hot stock tip or a get-rich-quick scheme. It's about a strategy. It's about owning a real hard asset in the most intelligent, secure, and efficient way possible. It's about reclaiming a degree of financial sovereignty in a world where our wealth is increasingly digital, abstract, and subject to the whims of central bankers and politicians. Owning gold this way isn't about betting against America. It's about ensuring the wealth you've built within the American system. It's the financial equivalent of having a fire extinguisher in your house. You hope you never have to use it, but if the flames start to rise, you will be profoundly grateful you had the foresight to put it there. The world is changing. The tectonic plates of finance are shifting beneath our feet, and in times of great change, it pays to own something timeless.